Okay, one other thing we talked about, and I don't think we've ever seen, but one of the questions that we're going to be seeing on Tuesday is how to set up a petty cash fund. Some of you will remember talking about this in class, but it's very simple. When you set up a petty cash fund, you create an account called petty cash, and you take the money from your account called cash. So if you to set up a petty cash fund, you do the date, then you debit your account called petty cash for whatever the amount is. Let's say we're going to set up a petty cash fund for $200. So we're going to debit petty cash for $200. The credit is going to be to, of course, cash for the same amount, and then we'll make our nice little description here. And that's how we set up a petty cash fund. Very simple entry. It's interesting then as let's say on the 15th of the month we have some we've given some people some petty cash to use for a trip, and say we gave them $100, and they had meals expense. In fact, let's just call that miscellaneous expense. That's just too detailed to call it meals expense. And it was $20, and then they had travel expense of $40, and then we're going to credit our petty cash fund for $60. Now we have a balance of 200 minus 60, or $140 in petty cash. Then finally, if we decide to replenish the fund, let's see. Then we would just do the same entry as we had before. So we've got a balance of $140 in petty cash. We want to juice it back up to the balance we used to have. We'll debit again petty cash and credit cash for the amount that we need. Well, if I could just spell, that'd be great, wouldn't I? And there's our entries for petty cash. The main thing I want you to remember is this first one, how to set up the petty cash fund, which is a debit to petty cash and a credit to cash. Very good. Okay, I want to do one more entry here on this same little video, and I'd like to look at the purchase of a property, plant and equipment asset, in this case a vehicle, the recording of depreciation on the vehicle, and then the sale or disposal of the vehicle. In this case, let's say on the 1st of January of 2012, we buy a car for $25,000. We sell it 2 years later, at the end of the next year, end of 2013, for $12,000. In between, we recorded 2 years worth of depreciation for $8,000. So let's just look and see how that turns out. We'll record the purchase of the car, debit, whatever, you can name the account whatever you like, but let's name it car. We paid cash for it, and we make our description there. At the end of that year, we're going to record depreciation. let's say depreciation is $4,000 a year. So depreciation expense car $4,000, accumulated depreciation car $4,000, and the description. Since we kept the car for 2 years, we're going to do that again next year. So at the end of 2013, our adjusting entry is the same, and that's our car now has a net value of $25,000 minus $8,000, or $17,000. So if I sell the car for $17,000, I have no gain, no loss. If I sell it for less than $17,000, I'm going to incur a loss, and if I sell it for more than $17,000, I'm going to record a gain. So what I do is I do all the rest of the entry before I record the gain or loss, and then I'll know which side to put it on. If it goes as a debit, of course, anything on the income statement that's a debit is going to be negative, so that'll be a loss. And if it ends up being a credit, then that'll be a gain. Again, I like to hedge my bets, and I usually name that account gain or loss on disposal of assets or sale of assets. That way I can put it as a debit or a credit. But a lot of people use two accounts, one called loss on sale of assets, which is a debit account, and gain on sale of assets, which is a credit account. I just like to cheat, but we'll do it this way. Let's say we sell the car then on the last day of 2013 for $12,000. I'm going to go ahead and record cash. Again, string and beads, I know cash is going to be a debit of $12,000. I also know that accumulated depreciation was recorded for $8,000, and it needs to be a debit. And then I also know that I'm going to have a loss of $5,000 on the car. 12 plus 8 is $20,000, and I have a $25,000 value of the car, or historical cost of the car. And you could do it this way. You could just go ahead and put cash, accumulated depreciation, know your debits, put your car in as a credit down here, your asset that you're getting rid of, leaving a line, and then just kind of add them up if you don't see that in your head. And anyway, it's a good idea to go ahead and check this. So let's just add up that, and that's $25,000. These three items are $25,000, so we know we're right here, and we can record the sale of the car. So to reiterate, when we buy the car, we debit car, credit cash. When we depreciate the car, we debit depreciation expense, credit accumulated depreciation. We've done it again, so we have $8,000 in our accumulated depreciation account. And so when we sell the car, we're going to debit cash for whatever we've gotten from the buyer. We're going to debit accumulated depreciation for the total in the account, in this case 2 years at $4,000. We're going to credit the vehicle, the asset account, for $25,000. And and the difference is going to go here, either a loss on disposal of assets as a debit, or a credit as a gain on disposal of assets. And again, I'm just going to tell you, I like to do it this way: gain or loss on the sale of assets. And I can just put that one down and then put the number in either place it goes. Again, I like to make things easy. I'm just not smart enough to do it any other way. But thanks. I hope that helps.